Hello, very good morning to all and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Thursday, the 28th of November 2024. So before we start our gist of today's Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap first on what has taken shape yesterday in terms of the performance of the intraday movement of the broad-based cross-asset classes that we covered on a daily basis from the major stock indices, the major FX pairs, as well as the two key commodities market, which is gold XAU/USD and as well as the West Texas crude oil. And also I will do cover is what are the important economic data release that actually impact these movements. And lastly, we will actually touch on the short-term intraday technical outlook for today on these broad-based cross asset classes. So yesterday's key data release is more pertaining to the state of the US inflationary trend in the US that could potentially shape US monetary policy decision going forward in 2025. It's the all-important PCE price data release yesterday. So let's have a quick look at the economic calendar on what is the trend like over here. So what you could see, the key focus will be more on the instead of the month-on-month, we stretch down to look at the year-on-year basis, right? The core PCE price index on the year-on-year basis, which is over here. Okay, so why core? Because it strip out the volatile item like energy and food prices in the US. So you look at the core PCE price index over here is that, yes, it came in within market expectation of 2.8% year-on-year. But if you look at the trend of the core PCE, if I'll open up the chart, okay, for you guys to actually have a better view of the inflationary pressure situation in the US. Okay, let's load for a while. Okay, so what you could see over here is that since the deceleration trend has taken shape at the start of this year, it plateaued in May and June, like at around 2.6%, and thereafter from July onwards it starts to stabilize. And what we could see over here is that after 3 months of 2.7% year-on-year from July all the way to September, it managed to actually blip upwards to 2.8% year-on-year in October. So if you look at the 3 or the 5-year trend, it seems that there is some signs of bottoming inflationary pressure in the US. All right, that means i.e. previously it hit a high of 5.6 in 2022, so that was close to 2 years ago. It decelerated, and this allowed the Fed to actually cut interest rate this year before the start of the US presidential election outcome. And right now, even before Trump coming into the picture next year with his new what I call flagship American First policy, that is higher tariffs and as well as steeper corporate rate tax cuts, steeper corporate tax cuts that would ignite inflationary pressure in the medium term to long run. What we could see over here is that the core PCE price index has starts to stabilize be above the 2.6% level. So that actually create a bit of fearfulness in the marketplace that inflationary pressure is no longer deceleration or decelerating on the downside as what market intended to be 2 to 3 months ago. And that will also potentially lead to what I call US Federal Reserve to be less generous in its interest rate cut cycle this time round. That means going forward next year, that could be also potentially at risk of no rate cuts at all. All right, so later I'll share with you on the CME Fed Watch 2, what is the market pricing like. But that has already impacted on the FX market, and we know that the FX market is much more sensitive to this kind of global macro movement, where we start to see the dollar strength starts to come back into the market on a short-term basis by looking at this 5-day rolling performance of the dollar against the major currency as of now we are speaking. So previously at the start of this week, for those who follow our daily market insight, we flipped to a bearish bias on the dollar strength. That means, i.e., bullish bias on the euro dollar, the sterling dollar, and the dollar yen, looking for a potential dollar strength setback story or pullback story. And apparently, this setback and pullback story is likely to be over based on yesterday reinforcement new of the PCE price data that is showing PCE inflationary trend has started to stabilize above the 2.6% level. Less likelihood for the Fed to be much more generous in the interest rate cut next year, and we start to see the dollar strength starts to actually tick up on a intraday basis yesterday, especially against the dollar, especially against the yen, where the dollar starts to actually cover this gap, where the yen was the dollar yen actually weakened significantly against the rest of the other major currency, also due to the fact of the risk sensitive factor, given the fact that Trump's we call it trade tariff tantrum that starts to play out again on early Asia session Tuesday, where he actually tweeted, or where he actually posted on his Truth Soldier network that he threatened additional 10% tariffs on China products and 25% tariffs on all Canada and Mexican products heading to US. So that actually saw the dollar yen significantly tumbling by a much more faster magnitude against the other major dollar pair. But right now, the dollar yen has started to actually gain pick up steam to cover this wide gap earlier on that was seen at the start of this week. So later we will touch more about the short-term intraday technical outlook. But going forward, given this kind of inflationary trend that is taking shape in the US right now, that means, i.e., there is a risk that inflationary trend in US is no longer deceleration on the downside, that what's the Fed intended to be earlier on, and that could potentially lead the Fed to be less generous in their interest rate cut cycle this time around, heading into next year, with a risk of even no interest rate cut for next year. That could potentially see longer term or major uptrend of the dollar strength still remains intact for the FX market. Okay, so that's pertaining to the FX market story yesterday. And also, very interestingly, what we could see over here is that this higher inflationary trend that potentially that could actually starts to creep into the US economy next year, saw the underperformance of that risk-sensitive mega cap technology stocks that has been pretty much apparent, heavily weighted on the SPX and the Nasdaq 100, that starts to see the underperformance against the Dow Jones and the Russell 2000 again. So what we could see over here is that this Trump trade continues to take hold on the major US stock indices, where the Dow Jones Industrial Average and the Russell 2000 should potentially continues to outperform the heavily weighted mega cap technology stocks that is centric on the Nasdaq 100 and the SPX from a longer term perspective. Yes, on the intraday perspective, we may see a bit of rotation between the mega cap stocks and the non-mega cap stocks, but on a longer term perspective, if we stretch the time horizon to a multi-month or to a multi-week perspective, the outperformance of the Dow Jones and the Russell 2000 may continue to be intact due to this Trump trade narrative that is still being played out in the marketplace right now in the US stock market, pardon me. So the SPX actually underperformed, the Nasdaq as well, down negative 0.4%, and the worst hit was the Nasdaq 100, down negative 0.85%, whilst the Dow Jones is down by a smaller magnitude of negative 0.3% and almost unchanged for the Russell 2000. And one of the reasons why the Nasdaq 100 actually underperformed by negative 0.85% is due to the one of the negative news flow pertaining to the third largest weighted stock in the Nasdaq 100, which is Microsoft. So there is a potential Microsoft may face potential antitrust investigation from the US FTC. So that could create a bit of negative feedback loop into the share price of Microsoft yesterday. So this be pretty much apparent if we were to actually look at the heat map of the S&P 500 component stock yesterday. This is a daily performance. So a sea of red in the mega cap technology stocks over here. Microsoft was one of the worst hit among the mega cap technology stock, other than Tesla, negative 1.17%. Spreading over to NVIDIA as well. And like I recall yesterday in one of my intermarket dynamics, you can actually take a look at yesterday YouTube video. I shared with you all that despite NVIDIA's stellar outperformance, the entire US semiconductor share price performance by looking at the SOX ETF, the SOXX, is not actually doing as well. Okay, so that could also potentially lead to a drag on the performance of the Nasdaq 100 from a medium-term perspective. So that actually explained to me why I actually turned neutral on the Nasdaq 100 yesterday, given the hesitant of the bulls to break above the 20,990 resistance level. So later we touch more again on the short-term technical outlook on the Nasdaq 100 when I covered on the short-term intraday perspective on the broad-based cross asset classes later in today's daily dose. All right. And also, what's interestingly for gold price yesterday, I do highlight that gold at the start of this week, yes, we may see a bit of short-term rebound, but this short-term rebound may not be the start of a new impulsive up move to see fresh all-time high. All right, so I highlighted key resistance level to watch 2,650, 2,660, where gold actually hit yesterday's level at 2,660 before it shaped that bearish reaction of that level. So gold price going forward may face a bit of we call it hesitant by the bulls to push up further higher due to this changing dynamics of the US monetary policy going forward by the latest PCE price data released yesterday. All right, and oil price continues to remain lackluster below the US dollar $70 per barrel on the West Texas crude oil due to this ceasefire narrative that has been broken out, that has been done by Israel and Hezbollah, tend to actually negate the geopolitical risk premium situation in the Middle East. All right, so that's sum up yesterday's news flow, important news flow, and their respective price action impact towards the broad-based cross asset classes. All right, so today there will be no intermarket dynamics. So straight away, I will jump straight into the short-term intraday technical outlook on the various broad-based cross asset classes that we tend to cover on a daily basis. So without further ado, let me expand my screen so that you guys could actually have a better look at the charts. All right, so let's start with the intraday technical outlook on the FX market first. Over here. Right, so let's start with the euro dollar. Still recall that euro dollar at the start of the week, this week, we look out for a potential bullish bias, but this bullish bias is more or less a mean reversion rally or mean reversion rebound within its medium-term downtrend that is still intact. And yesterday, rebound has already led for it to hit the resistance level at 1.610 level. So what I could see over here is that this rebound since Monday or late last Friday is in the form of a bearish flag, and now it's coming to the upper limit of the bearish flag at 1.610. So I give a bit of excess above 1.610, which is the 1.660 slash 1.0680. So I'll be using 1.660 slash 1.0680 as my short-term pivotal resistance for today. A bit of potential residual push up. We flip to an intraday bearish bias on the euro dollar for today. A breakdown below the lower limit of this bearish flag support level at 1.050 potentially could ignite another form of impulsive downward sequence on the euro dollar, potentially revisiting 1.0410 slash 1.0330, which is the intraday low on last Friday. Right, only a push up and an hourly close above 1.0680 will invalidate today's bearish bias on the euro dollar to see the continuation of the extension of this mean reversion rally towards the next resistance level that we do need to take note of will be at 1.0770, 1.0825, which correspond to the 50-day and the 200-day moving average, acting as a similar resistance zone as well. All right, so that's for the euro dollar. Flipping back to a bearish bias, taking into account that we may now potentially hit the exhaustion point of this ongoing mean reversion rebound that has taken shape since late last Friday. Very similar on the sterling dollar as well, almost hitting our first, not even hitting our resistance level of that mean reversion rebound at 1.2710. Put a bit of slightly excess up above 1.2750, which correspond to the downward sloping 20-day moving average, using 1.2750 as my short-term pivotal resistance for today on the sterling dollar. Flip back to a bearish bias on the sterling dollar, given the fact that we may already reach the end of the potential mean reversion rebound that has taken shape since late last Friday. First support level to watch will be at 1.2570, which correspond to the minor ascending trend line from the low of last Friday. A breakdown below this level potentially reinforce the start of another round of impulsive downward sequence for the sterling dollar to expose the next near-term support level at 1.2460 slash 1.2440 in the first step. Only an hourly close and a breakout above 1.2750 short-term pivotal resistance for today on the sterling dollar invalidates today's bearish bias to see the continuation of the mean reversion rebound hitting up towards 1.2840 and even 1.2960, which correspond to the downward sloping 50-day moving average. So in a nutshell, similar as the euro dollar, the whatever rebound that we start to see on the sterling dollar since late last Friday is coming close to an inflection level at 1.2710, 1.2750. So 1.2750 short-term pivotal resistance. As long as this level is not being surpassed, there's a risk that the sterling dollar would potentially kickstart another potential new impulsive down move to actually resume its medium-term downtrend phase. So that's for the sterling dollar outlook, technical outlook for today. Now, turning our attention will be the Asia Pacific currency against the dollar. So we're starting with the dollar yen. So the dollar yen, since the start of this week, we flipped to a bearish bias. So as intended, the price hit our support level, which is the 50-day moving average, before shaping this minor V-shaped recovery. And what we could see, positive element has started to take hold on the hourly RSI, hitting the oversold level, and right now it's breaking above this key parallel descending trendline resistance. And what it did over here, it break out and did a positive reaction of it as well by shaping a higher low over here, this low higher than this low. So net overall, what we could see, some signs of short-term bullish momentum has started to re-emerge in the dollar yen, and with that positive observation that is being taken hold right now on the hourly RSI, we will flip to a bullish bias on the dollar yen for sure, using 150.30 as our short-term pivotal support for today, which correspond to the rising 50-day moving average as well, where it paused yesterday's sell-off. First resistance level to watch for today will be 152.15 level, followed by 153.30, 153.70 on the intraday basis. All right. So let me put it in writing. 152.15. Okay. So I repeat. So for today, we will flip to a bullish bias using 153.30 as my short-term pivotal support on the dollar yen. Two near-term resistance level to watch on our bullish bias for today, 152.15 followed by 153.30/153.70. Only a breakout above 153.70, which correspond to the 20-day moving average, acting as a resistance level as well. Reinforce the start of an impulsive up move on the dollar yen in first step, exposing the next intermediate resistance level at 154.90. Only a push down and hourly close below 150.30 will invalidate today's intraday bullish bias on the dollar yen to see the continuation of this multi-week corrective decline scenario unfolding further towards the downside, exposing the next support zone at 149.30/148.85 in the first step. Okay, so that's for the dollar yen. Now, turning our attention will be the Aussie dollar. Still recall that Aussie dollar, we were neutral yesterday between 0.650, despite the fact that the dollar strength setback has taken hold in the other major currency pair, but we are not convinced of the Aussie dollar able to push up further due to its proxy with the Trump trade tariffs rate. All right, so with that, another hesitation at the 65 figure level. So we'll use a slightly higher level just in case of any whipsaw in today's thinner liquidity condition due to the upcoming Thanksgiving holiday. 65.45 as my short-term pivotal resistance level, which correspond to the downward sloping moving average. As long as 65.45 short-term pivotal resistance for today is not surpassed the upside, we will flip back to a intraday bearish bias on the Aussie dollar. Key support level to watch on the medium term will be 64.10, 63.60. What's this level important? If we were to go to the daily chart on the Aussie dollar, this level over here is in fact corresponding to the major ascending trend line that is in place since 13th of October 2023 low. The lower limit is 63.60. All right, so a breakdown below this 63.60 potentially could start to see a major bearish impulsive downward sequence unfolding on the Aussie dollar that could potentially take shape from a longer time frame, multi-week to multi-month. Right, back to the hourly chart again. So if we start to see a price, whoops, this is the dollar yen, pardon me, Aussie dollar. If the price action starts to shape a break up with an hourly close above 65.45, then today's intraday bearish bias will be invalidated on the Aussie dollar to kickstart a mean reversion rebound scenario, heading up towards the next intermediate resistance level to watch will be at 66 figure, followed by 66.40, which correspond to the key 200-day moving average, acting as a similar resistance area as well. So that sum up the intraday technical outlook on the major FX pair, looking for some signs of dollar strength coming back into the FX market. Now, turning our attention will be the short-term intraday technical outlook on the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 was very nasty yesterday. So it seems to us that yesterday we do have a short-term tighten short-term pivotal resistance, not yesterday, since the start of this week at 19,480. So during the close of the session, it managed to push up. And right now, once the Hong Kong stock market, cash market reopened, it failed to have a positive follow through. So yesterday's push up over here above 19,480 deems to be as a failure bullish breakout. So our turn neutral for today between 19,880, which is correspond to the downward sloping 20-day moving average, and as well as the support level that the best fails to break through since the start of this week at 19,080. Only an hourly close below 19,080 will increase the conviction of the continuation of the impulsive down move, at least in the short term for the Hong Kong 33 to expose the next near-term support level at 18,740. A breakdown below 18,740 exposes 18,200, which correspond to the key 200-day moving average. Only a pushback up with an hourly close above 19,880, then we could potentially see a more meaningful short-term recovery taking shape on the Hong Kong 33 to expose the next near-term resistance level at 20,150, followed by 20,490, which is the 61.8 Fibo retracement of this ongoing downtrend that is taking shape since the start of 8th of November high. Okay, this goes to the 68% Fibo retracement at 20,490, pardon me. So that's for the Hong Kong 33. So deemed as yesterday's push up above 19,480 as a potential failure bullish breakout. Now, what's next for the Japan 225? So the Japan 225 as intended hit our first support level 37,765 before shipping that bounce, and right now is coming back close to our short-term pivotal resistance level again. And the bounce that has taken shape on the hourly RSI, there is no form of a bullish divergence. That means price actions continues to shape lower low over here, so indicating that we may still be trapped in this kind of sideways range configuration below this minor descending trend line that is still in place since the high of 6th of November. So using 38,670, a bit of excess at the 200 at this upper limit of this at the minor descending trend line resistance, which correspond to the minor swing high of 25th of November. 830, so a bit of excess, 38,670 slash 830 with excess. So this will be my short-term pivotal resistance that I have for the Japan 225, i.e. the Nikkei 225. Still maintain that intraday bearish bias. First support level to watch will be yesterday's support zone or support area at 37,765, pardon me. A breakdown below it exposes the key medium-term support zone of 37,390 over here, which is the start of this complex sideways range scenario since 27th of September this year. Only a push up and hourly close above the excess short-term pivotal resistance zone at 38,830 will invalidate today's intraday bearish bias to see the price action of the Japan 225 floating upwards towards the upper limit of this complex sideways range configuration, with next resistance coming in first step at 39,090, followed by 39,550 over here. Now, what's next for the European stock indices with the German DAX? So the German DAX and the German 30 continues to be trapped as well in this vicious sideways range configuration since the all-time high that was printed on 17th of October, and recent price action continues to shape a series of lower high as being depicted by the descending trend line in gray since the high of 28th of October. Rejected once, rejected twice, and right now the descending trend line resistance is at this level here, which is 19,405 level. So I will have a more conservative, more stringent reward risk ratio set for today's intraday technical outlook using this level here, 19,405, which correspond to the descending trend line that is in place since the high of 29th of October that was rejected 3 times, 1 time, 2 times, 3 times. So this resistance level now is at 19,405. All right, so this will be my short-term pivot. Okay, so this one will be the next resistance level. Okay, let me do some adjustment. All right. So using a Titan key short-term pivotal resistance for today, 19,405, still maintain that intraday bearish bias on the German 30. First support level to watch will be yesterday's minor swing low at 19,155 level. 155. A breakdown below 19,155 potentially exposes 19,050 next. Okay, so these are the two intraday support level to watch. However, a price action managed to surpass above 19,405. Then today's intraday bearish bias will be negated to see a push up to revisit 19,510 slash 19,560. Only a breakout above 19,560, potentially see a retest at the all-time high area at 19,690. Right, so this is the key levels to watch out for the German 30. Still maintain that intraday bearish bias. We in a sideways complex range on the German 30. Intraday bearish bias, yes. So now what's next for the US major stock indices? So the US Wall Street 30 or the Dow Jones Industrial Average continues to outperform against the Nasdaq and the SPX 500. So still no change, still using the 44,520 as my short-term pivotal support level on the Nasdaq, not on the okay, pardon me, I repeat again, I'm still maintaining that for 44,520 as my short-term pivotal support for the US Wall Street 30, i.e. the Dow Jones Industrial Average. Two key resistance level to watch in the near term on the intraday basis will be 45,070. A breakout above it exposes 45,450. So 45,450 is in fact correspond to the upper limit of this major ascending channel that is in place since the low of 27 October last year. Okay, now back to the hourly time frame. Only a hourly close and a breakdown below 44,520 will invalidate today's intraday bullish bias on the US Wall Street 30 to kickstart another mean reversion decline scenario, exposing the next near-term support zone at 43,980 slash 43,807. We also correspond to the rising 20-day moving average as well. All right, so that's for the US Wall Street 30, still maintaining that intraday bullish bias with key short-term pivotal support at 44,520. Now, what's next for the Nasdaq 100? So the Nasdaq 100 yesterday returned neutral. Price action indeed hit the lower limit of the neutrality zone, managed to survive and stage a bounce of it at 20,640. So given that today the US stock market will be closed, all right, due to the Thanksgiving holiday, and also on Friday, there will be lower liquidity as well because the US stock market will only be open half day, I think, until about should be around 1 a.m. Singapore time, all right, if I'm not wrong. So we will, due to the lower liquidity environment in the US stock market in these 2 days, we will still maintain that neutrality stand on the Nasdaq 100, 20,990 and 20,640. Only a hourly close breakdown below 20,640, which is all breaking down the 20-day moving average, then that could actually unfold more of a pronounced weakness on the Nasdaq 100 to expose 20,460 again and 20,335 in the first step, which correspond to the rising 50-day moving average as well. All right, so that sum up the intraday technical outlook on all the major stock indices that I share with you guys. So now turning our attention to the commodities market, starting with gold XAU slash USD. So for gold, still recall, yes, we flipped to a bullish bias in the start of this week, but this bullish bias, we are taking things one step at a time over here. So indicating that there's still a risk that gold could resume this kind of multi-week downtrend scenario. We in a major uptrend bullish phase. All right, so on the shorter term, on the hourly chart, the price action yesterday hit our first support zone at 2,650, 2,660, but has this bearish reaction of the 20-day and the 50-day moving average. All right, and what we could say over here is that potentially this bearish reaction over here, if you look at the daily chart, okay, it formed into a shooting star, a bearish shooting star on the daily chart over here. So given the bearish price action on a daily basis, there could be a risk that spot gold has already more or less exhausted the rebound move that has taken shape since Monday. all right, Monday or the start of this week. So with that, we will flip to a bearish bias for today on gold XAU/USD using 2660 as my short-term pivotal resistance level. First support level to watch will be at 2600 slash 2590. A breakdown below 2590 potentially could start to see a much more drastic bearish movement on the intraday basis to revisit 2546 slash 2526 level, which was actually the tipping point on 14th of November that led to the very fast and furious rebound, okay, that took shape. Okay, only an hourly close above 2660 will invalidate today's intraday bearish movement on gold to see extension of this rebound, exposing the next near-term resistance level at 26,890. Above 26,890, potentially revisit the high of 25th of November, 20, which is Monday, 27,280 slash 27,15 slash 2728. All right, so that's for the intraday technical outlook of gold. Given the negative price action movement that was seen yesterday, we will flip to a bearish bias with 2660 as my short-term pivotal resistance level for today. So looking at the longer term picture for gold, I want to stress you all, this is the daily chart for gold over here. So on the daily chart for gold, the major ascending channel from October 2022 low still remains intact. So what we could see over here is that the major trend of gold still remains intact. All right, but what we are seeing right now in terms of an Elliott wave perspective is a bracket wave fall, a corrective wave fall. So what I mean over here is that from the low of 1615, 28th of September 2022 low, this is a wave one over here. Okay, a bracket one. Okay, 6 October 2023 low at 18,010. This is a bracket 2, Elliott wave 2. And what we could see over here is that this very sharp rally, almost a year already, this is the 3. Okay, okay, that entered at the current all-time high level around 2,800. And what we are seeing now is a miss of a wave 4. All right, so this potential wave 4 that is still unfolding. So what I mean is that yesterday's bearish reaction of it, right, at the 20-day moving average, at 50-day moving average, could potentially see the wave 4 extending more towards on the downside. So what I mean over here is that this particular low that was seen on this area here, okay, this low 2,536 that was hit on 14th of November may not be the wave 4 low, the corrective wave 4 low. That means this wave 4 could be a zigzag A, B, C to complete the 4 at around the 200-day moving average over here, which support at 2,484, 2,415. And if you do the Fibo retracement, okay, that's give us 30% as well at 2,415. And if we do the one-time extension from the wave 3 high, project it downwards, okay, that's also give rise to the 2,484, 2,415 zone. So that means from a longer term perspective, multi-week perspective, this multi-week weakness could still continues to unfold in gold based on the Elliott wave perspective over here to see the completion of that wave 4 at around the 2,484, possibly 2,415 level. So around at this level here, 2,484 slash 2,415, which is also correspond to the rising 200-day moving average. So this could be the start of a new impulsive up move where gold could potentially see higher high and higher low thereafter. But right now, from a shorter term perspective, the odds seems to be much more supporting the bears than the bulls for gold XAU/USD. All right, so that's the longer term chart that I'll share with you guys for gold. Right, so now lastly will be the West Texas crude oil. So West Texas crude oil continues to shape a series of lower high holding below the 70-80 short-term pivotal resistance that we highlighted earlier on. So still no change. First resistance level to watch for today will be 69.50. So as long as any rebound didn't surpass above 70-80 short-term pivotal resistance level, we will still maintain that intraday bearish bias for gold towards 67.55/10, maximum 65.70, which is the lower limit of that major descending triangle range configuration on the daily time frame chart that I flashed to you guys again for a recap. 65.70 over here, that's in place since 20th of March 2023 low. Right, so right now it's involving in this kind of descending triangle range configuration. Only an hourly close above 70.80 on West Texas oil will potentially see a much more meaningful mean reversion rebound towards the upper limit of the descending triangle range configuration. In first step, the next resistance to watch on the intraday basis will be 71.80, followed by 73.15. All right, so net still maintaining that intraday bearish bias using 70.80 as my short-term pivotal resistance for West Texas crude oil. So that actually also sum up the intraday technical outlook on the broad-based cross asset classes. So we know that today's will be US Thanksgiving holiday, so it'll be a rather quiet session. So let's look at the economic calendar. What are the European data to take note of for today? All right, so for today will be Thursday over here. So what I could see is that in fact there is one news flow that could be pertaining to the Aussie dollar, and the Aussie dollar crosses will be at 4:55 p.m. Singapore time, which is RBA Governor Bullard will be giving a speech during the European session. And what we have over here is that we do have German CPI data that is out at 5 p.m. Singapore time over here, and followed by Eurozone economic sentiment data for November out at 6 p.m. Singapore time. All right. And we do have also another ECB officials Edison speaking at 9 p.m. Singapore time. All right. And thereafter, there should be a quiet session given that the US market is closed for Thanksgiving holiday today. So with that, that sum up today's daily dose of market insights. I'm Kelvin here, signing off, wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.